So for moving away from the generally publicly traded liquid kind of assets that you normally associate with wealth managers into the private real estate world, what are the primary drivers for doing that? Why do you take on that burden now of going out and getting to know a sponsor? Tell me why is that a good thing?
Very fair question. So first, the investors have to be qualified as accredited investors to do this. And that takes a fiduciary like myself to say you have enough assets and enough income. And if you lost this money, it would not detrimentally affect your life. So that's number one, is screening people. Number two is, so when I was a venture capitalist, if you're going to take that kind of risk where you have less liquidity, less transparency, less information, and you may have to hold it 5 years, you have no control over the sale, just like the sale of your home. It's difficult, right? We can't predict it. If you're going to do those things, the investor demands higher return. So the benefit to the investor is higher return. Venture capital, when I was doing biotech, my lead investment in Wolverine Venture Fund, Handy Lab, doubled the fund size, mine and the fund members. Over 5 years, we doubled the fund size. What that really means is that investment went up like tenfold. And some things went up okay, some things sat flat, some things lost money. We luckily had a 10 banger, so the whole fund did well. And so I let people know that there's high risk, but with high risk, investors demand high return. And if the high return doesn't occur, they move on to better organizations, right? So that's where you look at history. You can look at what are the returns in the past? How well have they interviewed managers? How well have they scrutinized those firms without micromanaging them to death? Because you can kill the company like Shark Tank. So, you know, it's a balance, really. It's a balanced system where the more risk you take, you should have more return. Now, there are inefficiencies. And I'm pleased to say that the private market is one of those inefficiencies. If you have good research and you find good managers and you network well and you have a good system of due diligence, you may find private investments whose returns are well above their risk profile. So we've seen things in the 20, 30, even 40, 50% year-over-year return ratio, which is very, very attractive. Now, having said that, if we're seeing that kind of stuff, there must be stuff going to zero, right? And so that's what you have to do, is be able to tolerate the risk. The investor has to be able to swallow it if it doesn't go anywhere. It's a cherry on top if they win. They get to brag if they win. Who cares if they lose? That's how you have to treat it.